Today, folks, we're going to be analyzing Meet Kevin's new ETF that he recently just announced is going to be coming live. He's going to be ringing the bell at the New York Stock Exchange, I think within the coming week. And I thought it'd be fun to just dive down into not only the top 10 holdings, but take a look at the structure of this ETF, the things I like, the things I don't like, and personally, my own opinions on it, because it is a managed fund. I do not like managed ETFs, mutual funds. Typically over a 20-year period, less than 5% will actually outperform the S&P 500. But I know a lot of Meet Kevin fans out there would probably be pretty happy to see something like this, considering so many of us, YouTubers are like, hey, it'd be great to start our own ETF. So I am kind of excited to see how this kind of rolls out for Meet Kevin, as he also recently launched, obviously, his house hack. I feel like I'm just promoting his stuff here. But we'll get into some of the opinions in a bit. But let's just take a look at this, folks, because here it is, the Meet Kevin Pricing Power ETF. The ticker symbol is PP, which is very funny, literally PP. And taking a look, guys, first and foremost, the thing that I noticed right off the hop that obviously discourages me a lot is this expense ratio. Now, I did watch the video where he discussed how much money he plans on making off this ETF. And unless I think he ends up getting this up to like $50 or $100 million in funding, that like he's not even going to be breaking even. So, you got to put a lot of money into this ETF, because it costs like $500,000 plus just to operate these things. I looked into it in Canada, and usually just to get an ETF started cost over $1 million bucks. You do need a lot of capital at hand, and the expenditures are really high. But a 0.77% fee expense ratio is exuberant. Like, that is in the upper percentile. I mean, getting close to 1%. Most ETFs, in my personal opinion, I would not touch. Paying, anything at a 0.5 or higher, to me, is just far too much of an expense ratio. So honestly, if you're looking for ETFs, even if the managed ones, I'd be trying to stick closer to anything between 0.2 and lower. I mean, Vanguard, most of their ETFs are like 0.01, 0.05, like really incremental in comparison. And I'm going to tell you some of the ETFs that I look for and what I look for in ETFs, because again, this is an actively managed fund. So Meet Kevin plans on trading within this fund to outperform the market. And let's just read into some of the key statistics here, because the Meet Kevin Purchase Power ETF is an actively managed exchange-traded fund that seeks to achieve its investment objective by investing primarily in U.S.-listed equity securities of innovative companies, similar to the ARK Innovation ETF. I know Meet Kevin poked some fun at good old Kathy Wood there. The Meet Kevin Purchase Power ETF, categorized as an innovative company, as a company to be involved in the development or new product or service technology advancements, consumer engagement, and or disruptive approaches with respect to business growth, that the sub-advisor expects to have a significant impact on the market or industry in which the company operates. Further, the Meet Kevin Purchase Power ETF will invest in the innovative companies that, in Kevin's view, also have a more pricing power than their peers. So these are companies with good moats. The Meet Kevin Purchase Power ETF, I feel like this is going to become a tongue twister here, generally analyzes pricing power based on price elasticity, which is the ability to potentially increase prices for products and services without corresponding drop in demand, blah, 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 blah. Let's just get into this, because it kind of just rehashes it here. And let's just break down these stocks themselves, because there are some interesting stocks in this ETF, and the structure of it I found relatively intriguing. This ETF sounds awful, seems like a worse ARK. Well, see, that I don't want to put any direct opinions on this. Like I said, I'm just trying to guide some people on if this is something for growth. Like if you're looking for a smaller percentage of your portfolio, you could go in this direction. Obviously, it just comes with a hell of a lot more risk. We can see at the top of the list here, guys, 22.43% of this ETF is Tesla alone. Now, I do have a general rule of thumb that I almost broke my rule with buying VDY, because the top weighted stock in VDY is Royal Bank at 13%. I have a hard time wanting to buy an ETF when the top two stocks, so he's got Tesla and Apple. Apple is at 14%, Tesla at 22%. I mean, that's crazy, right? I mean, when you take a look at that exposure rating, guys, almost 40% of this entire ETF is just within these two stocks. So, I mean, you could pretty much replicate this ETF just by buying these two companies and not paying the expense ratio. But I want to focus more or less on the stocks that I find really intriguing. I should touch on Tesla as well, because Elon Musk is kind of becoming concerning with Twitter. But nonetheless, guys, take a look at this, because we do have this US Treasury 2-year in here. This is like a Treasury bond that I think yields 3.5%. Very intriguing to see that. It's about an 8% weighting. Taiwan Semiconductors, Trade Desk. These these ones are fairly expected. These are kind of your Meet Kevin kind of stocks, like Enphase, which has performed exceptionally well this year. Advanced Micro Devices, Lululemon is another really good company. NVIDIA, great company. These are arguably pretty expensive stocks all around, though. We're talking about like value plays. These aren't those kind of companies. Some of them, I mean, AMD maybe. But taking a look, what I found really intriguing was the UDN here. This is one that I've never seen before. It's the Invesco DBUS DLR index, which is basically bearish on the US dollar. And I want to share this one with you first because I've never actually seen basically a stock like this where you can start hedging and shorting the USD. And I've talked about the US dollar a lot. So let me just pull this up because UDN, I think is the ticker there. Taking a look at the year performance, guys, has just been getting wrecked because the US dollar has been rebounding so aggressively thanks to the interest raising environment. But lately, because the US dollar has fallen off, we're starting to see this bounce back because, again, it's hedging the USD. But if we take a look at the US dollar as it stands today, guys, like I said, I wouldn't play currencies, but it is an interesting hedge. In my opinion, you take a look at the year to date on the USD, guys, and it's just starting to pull back now as we know we're heading into the leveling off of interest rates. And as people are probably more likely moving back into equities, US dollar goes down, stocks go up. So this is kind of an inverse hedge almost, that if you think the US dollar is going to go down, you could technically just buy the stock market and you'd probably see similar performance. I just found this holding to be so fascinating because I've never seen a short US dollar. But taking a look, guys, let's just kind of analyze the entirety of the holdings because that's just the top 10. I did download the entire spreadsheet list. And he does have a lot of like your typical Warren Buffett stocks in here, like Occidental Petroleum. I found very interesting to be in here. It's kind of like this weird mix of companies that you'd probably see at more popular between value investors and growth investors, because a lot of your Warren Buffett stocks are in here, and again, a lot of Meet Kevin stocks are in here. So it's just an interesting fund in and of itself in that aspect. But you can't really trust any of the holdings because it doesn't sound like this is for a long time investment thesis. It seems like he's just holding these for the perspective of trading. If information changes, he'll change out these holdings. And I just love to know what you guys generally think on these, because personally, it scares the crap out of me if your two major holdings are Tesla and obviously Apple. Like, I know everyone has been so bullish on Tesla because the run has been so immaculate from like 2019 onward, but now it's down 50%. And I just don't see Tesla doing that well in 2023. Their growth rates are fine, but the growth rates cannot match, the bottom line fundamentals yet. And we don't have self-driving. We don't have Cybertruck yet. There's a lot of things that have to come into play. And the only thing that really scares me holding Tesla at 20% of this entire ETF is the fact that, Elon Musk is just going after all the big players. Like, he's been just battering Apple for the way they take 30% off the App Store. He's been really going at them, trying to get, like, should Apple publish all censorship actions it has taken in effect to its customers? So it scares me a little bit when you see these big CEOs starting to go at it. When Apple and Tesla start competing and Apple and Facebook start competing, it just becomes very belligerent, and Apple kind of has all the control. They are like the bully in the play yard. If they want to knock you off the App Store, they could easily do it, right? So I do not like the way Elon now has this free reign of freedom of speech where he can just say whatever he wants. I honestly think 2023 is going to be a nightmare for Tesla shareholders, because we're going to see Elon Musk as the person he is, which every person, guys, they have a good and a bad side to them. But when you just give them a free reign to do and say as they please in a public forum, you're going to see both sides of that person. So I am a little cautious to be investing huge percentages of an ETF just into an overvalued company like Tesla. And I am a Tesla bull long-term. I love Tesla. Like I said, this ETF is just a fascinating look into how Meet Kevin thinks. And I honestly think, from me watching Meet Kevin and all these different funds he's starting, I don't know how he's going to correctly manage it all. The dude's running like 10 or 20 different businesses. And I honestly think a lot of them are going to flop because he's just trying to do too much all at once. And he's just trying to raise money. Like, he's at this phase now where he realizes the next leg up is utilizing his users that have, they're accredited investors to try and get a big lumps of money, because you can make 0.75% and you start getting 100 millions in a fund, or $1 billion in a fund like Kathy Wood has, utilizing the audience he has. I mean, the dude's going to print money. I just don't think you're going to print money. I think if you want to get into house hacking, take his course and go do it yourself. I don't see why you'd pay somebody a fee to do that. I honestly, same thing with this ETF. I don't know what the point of paying a fee is when it's such a concentrated ETF. You can buy a few treasury bonds, Tesla, Apple, boom, you've replicated almost most of this ETF. So what would I be looking for in ETFs? Why am I so hypercritical of all this stuff? Because I think the big problem is you don't know what you don't know. And Meet Kevin's portfolio, though, is nicely rounded. I just don't think it takes into the consideration of these sidelined effects. I noticed in his video, he did mention that, if there's another geopolitical event, then he can switch out of oil or switch into oil and do this stuff. The problem is like, I just don't think people will make those decisions at a drop of a dime. I mean, you remember when Buffett was investing in Occidental Petroleum, a lot of people were calling that like the peak of the oil market. Carl Icahn, so I think he was the one that sold out of all of his Occidental right when Buffett bought in, only to see it go up even higher. And why I'm not playing that individual stock trading game is because you can't have a full perspective of every sector. You cannot be a genius in every sector. You either need to be a very good generalist in the market, or you need to be hypercritically focused on one sector like biopharma or psychedelics or whatever. So when it comes to that broad view perspective, I am highly ignorant on oil. Oil, if I was able to have the guts to buy it when it was down in March 2020 to like negative levels, that's when you would have made most of the money, right? So what I look for in ETFs are basically market weighted ETF. It's not like rocket science, right? Vanguard, the guy that rest in soul, Jack Bogle, the dude invented the ETF based off market cap weightings. It has nothing to do with feelings. It has nothing to do with macro events. It's purely just based off if a stock performs well. And if a stock performs well, it'll get a higher weighting in the ETF purely based off its market cap. And I don't think there's a better example than this right now than VYM. VYM is like one of these new stocks I added at the beginning of the year. And this thing is just genius because not only are these insanely cheap to hold, they've outperformed the S&P 500, basically utilizing the exact same tactics that VOO uses. And if we go take a look at the holdings here, guys, I've been watching the top 10 holdings religiously on all of these ETFs because in these volatile markets, these stocks get swapped out all the time. So things like Facebook and the S&P 500 got de-weighted so fast that, the S&P dropped 20%, but it didn't drop 60% like Facebook did. So if you don't know when to get out of these stocks, or even if you think they're cheaply valued, like Everything Money always, saying Facebook's a good buy, BABA's a good buy. They've been a good buy for the last year, but they continue to drop way more aggressively than the indexes. So you take a look because ExxonMobil was not at the top of any of these indexes a mere several months ago. And now, J&J used to sit at the top of this ETF, and now it's been surpassed by Exxon because Exxon market cap has done so damn well. So I just love the fact that this takes the feeling out. I don't have to know anything particular about the sector. And if you're just patient, guys, the best stocks will always work their way to the top. So even in an economic downturn, when everyone's saying the S&P is overvalued, oh my God, the S&P is overvalued, that actually doesn't matter as much if you're buying a market cap weighted ETF, because it'll naturally de-weight the losers out. So even if those stocks that get hit real heavy in an economic downturn, yeah, you might not see the crazy upside performance, but you'll get rid of the waste, the companies that are trash, without having any thought, without having any emotion toward it, without having any macroeconomic circumstance data coming in and driving you bonkers every week. So like I said, when it comes to these ETFs, I would highly, highly fixate on the lowest cost because, when you're trying to make money, guys, you can't be paying out almost 1%. Actually, sorry, I could probably see it at the top. I'll just go to Yahoo. Take a look at the expense ratio on this. 0.08. Meet Kevin is at 0.7. This is at 0.08, and it is outperforming the S&P 500 this year. If Meet Kevin showed his portfolio, I highly, highly doubt he's outperforming the S&P 500 this year. So it's exactly like stock picking is hard. I stick to index ETFs and a few stocks. That's exactly what everyone should basically do. Focus on market cap weighted ETFs that take the emotion out. Pick a handful of stocks you love. Try not to weight them more than 10 or 15% of your entire portfolio and just constantly reinvest in those companies. But I just don't trust. Look at Kathy Wood as a great example here. Go look at any managed mutual fund and find me one over a 20-year period that has outperformed the S&P 500. You should not be buying ETFs, option ETFs. Don't be buying things that don't have at least a 10-year track record. And even then, you can't trust the 10-year track record because that 10 years has been during one of the greatest bull cycles literally in human history. So you kind of have to understand that the data, backtracking data right now is super hard to judge. So this is why I pivoted so aggressively this year, is because I just don't know what I don't know. And in a market like this, I got slapped upside the head so many times that I think it's going to continue to happen for a little bit longer. I mean, you look at things like Algonquin Power and Utility Corp. I thought utilities would be one of the most stable sectors, and AQN, one of the largest Canadian utilities, got absolutely devastated. I couldn't have seen that coming. I thought they would have managed the debt better. Apparently not, right? But again, could I have predicted that going into that crash on earnings? No. So it's just like, how do you trust that management, a managed ETF can, that you trust them enough that over 20 or 30 years, they'll continue to actually make the right decisions? Because I just don't think they will. Actually, there's another ETF that I used to follow called Pershing Square Holdings. I don't know if you guys ever followed Bill Ackman, but this dude is an icon. Literally in my investing career. And this dude's actually like, you take a look at this ETF. Let me pull this up. Because this one's been one that I followed for a very long time. I almost bought it, basically just because I had idolized the dude so much. But I've learned not to meet your idols, because meet Kevin, or not meet Kevin, but Kevin O'Leary wrecked my portfolio once upon a time. I've talked about that story a few times. And if you listen to people like Meet Kevin, you're going to get wrecked. I'm not Meet Kevin, Kevin O'Leary, damn it. I don't want to throw Meet Kevin too hard under the bus, but here's Pershing Square Holdings. So this guy, Carl Icahn, like he was the one that was trying to say Herbalife was a Ponzi scheme. I wish he was talking out more about the crypto environment, but his ETF only just now is starting to recover. The max performance, guys, it's up 52%. There's no dividend yield on this. So if you bought it the day of launch, again, not a 10-year history here yet, really pretty decent performance, but nothing staggering, right? And this is an actively managed fund. If you bought it in the March 2020 crash, you've been doing great. But when you look at that long-term performance, guys, it still doesn't meet up to the S&P 500. Let's see. So this was back in 2014. It's up 52% since 2014. How does that match against the VOL, let's say? So if we go back to 2014 here, guys, we take a look. We'll go right back to the beginning of 2014, and this is up 122%. So even the likes of Bill Ackman, a multi-billion-dollar hedge fund manager, still can't outpace the S&P 500 since the inception. And this is a brilliant guy that buys businesses, changes management, very Warren Buffett-like investing. And if you are going to buy an individual, managed ETF, you might as well buy Berkshire. I don't think there's any other, ETF that's better off to be bought, because, Buffett at least has like a 30, 40 plus year track record. And again, you go back to 2014 and it's roughly at par with the S&P. It right now is outperforming just because it's jumped up so aggressively in this last little bit. Year to date, look at this, up 5%. There's not many ETFs, or not ETFs, but publicly managed funds that have actually done this well. And this is a good environment to speculate on. Like, I'm like, in the worst of times, this is when you want to look at these managed ETFs, because you don't want to look at them when they're in a 10-year bull cycle, because it's so hard to judge if they're actually making the right investments, because you just look at Kathy Wood. She looked like a genius up till this recent crash. And now we have to see if she made the right decisions over the next 10 or 20 years and if it can rebound. So honestly, guys, I'll pass the question off to you. I'd love to know what you think about the Meet Kevin ETF here. Are you guys going to be interested in buying it? Are you interested in any of his funds? I just thought this would be a fun video, because I feel like a lot of people are going to make more detrimental mistakes. You get caught up in these idols on YouTube. And if there's one thing we've learned over the last month, including myself, man, don't buy what I'm buying. Try and take the advice and work it into your own strategy, but do not, just don't buy any products that we're selling here, guys. It's probably not the best idea. When I mean products, I mean literal investment products, without doing a lot of due diligence and just coming to your own conclusion. And, I just feel like so many people have gotten wrecked. And even like, go watch Jeremy at Financial Education. I feel so bad for him. The dude's doing this 180 pivot, just out of nowhere. The guy's like, okay, I made a mistake. And I feel like that could be Meet Kevin in the very near term future. Because again, like it seems good when things are good, man, but man, to be managing people's money, it scares the shit out of me. I don't want to manage people's money. So I hope you guys enjoy this quick little live stream. Let me know what you think. Stay cool, stay awesome. And as always, I'll catch you in the next one.